Market bubbles have destroyed over $78 trillion in wealth across history, yet somehow we keep falling for the same psychological traps that created them. The human mind's capacity for financial self-deception is truly remarkable.
That's such an interesting way to frame it. Like we're all actors in this recurring economic drama, just with different costumes each time.
You know what fascinates me most? The way these cycles follow such predictable patterns. When you study market history, you see the same progression from rational optimism to complete suspension of disbelief.
Kind of like how in 2021, people were paying millions for digital art, NFTs, without questioning if the prices made sense.
Exactly like that. And it connects to this broader pattern where every generation thinks they've discovered some new paradigm that makes the old rules obsolete.
Well, that brings up something I've been wondering about. How do smart, experienced investors keep falling into these traps?
That's where the psychology gets really interesting. When markets are rising consistently, our brains actually start processing risk differently. Studies show that after experiencing steady gains, investors become 40% more likely to take on additional risk.
So it's almost like winning at a casino. The more you win, the more you convince yourself you've got some special insight.
Right, and then you add in institutional factors like leverage and financial innovation. Did you know that in the lead up to the 2008 crisis, the ratio of derivatives to global GDP reached 10-1?
Oh wow, that's staggering. And we're seeing similar patterns now with different instruments.
Absolutely. Take the growth in private credit markets. They've expanded from $400 billion in 2009 to over $1.2 trillion today. And just like in previous cycles, lending standards are getting progressively looser.
That reminds me of that famous quote. The worst loans are made in the best of times.
Well, you know what's really telling? Studies show that loans made at market peaks have default rates nearly 3 times higher than those made during normal periods. It's like clockwork.
So if we understand these patterns so well, why can't we break free from them?
That's where the institutional incentives come in. Look at private equity firms. When you have cheap leverage and limited downside, making aggressive bets becomes completely rational from their perspective. The system actually rewards the behavior that makes it more fragile.
Like how investment banks kept creating more complex mortgage securities in 2007, even though some traders were privately getting nervous.
Precisely. And here's what's wild. In every major bubble, you can find internal memos where someone raised red flags, but the pressure to keep dancing while the music's playing was just too strong.
You know what this conversation is making me think about? Those experiments where they put frogs in slowly heating water.
Oh man, that's such a perfect analogy. The gradual nature of market distortions makes them harder to spot. Like right now, we're seeing risk premiums compressed to historic lows across almost every asset class.
And I imagine most investors know this intellectually, but it's hard to step back when everyone else is making money.
Exactly, and that collective psychology creates these fascinating feedback loops. When everyone believes assets will keep rising, they act in ways that make assets rise, which reinforces the belief.
Until something breaks the cycle.
Right, and here's what's really crucial to understand. You never know exactly what will break it. Looking back at major market turns, the catalyst is usually something that seemed minor at the time.
So what should investors be watching for now?
Well, rather than trying to predict the specific trigger, focus on the conditions that make markets vulnerable. Right now, we're seeing classic late cycle behavior, minimal fear, compressed risk premiums, and this fascinating tension where investors are optimistic enough to chase returns but nervous enough to start hedging.
That sounds like a pretty clear warning sign.
You know what's interesting? Studies show that markets typically peak about 6 to 8 months after institutional investors start increasing their hedging activity. It's like they can sense the parties winding down but don't want to leave too early.
So we're in that dangerous period where everyone knows they should be careful, but no one wants to miss out on potential gains.
Exactly, and history shows this is precisely when maintaining perspective becomes most crucial. The time to worry isn't when everyone's panicking, it's when everyone's convinced nothing can go wrong.
That's quite different from how most people approach market risk.
Well, here's the thing. Markets don't reward us for predicting exact tops and bottoms. They reward us for understanding where we are in the cycle and adjusting our behavior accordingly.
Sounds like the key is staying rational when everyone else is either euphoric or panicking.
And that's probably the hardest part, because these cycles aren't just about markets, they're about human nature. And human nature, well, that hasn't changed much in the last few thousand years of financial history.